Hi, I'm Emma Everett, Team Leader for our Buyers Agency team here at Momentum Wealth, and today I'm joined by Calum Merrick, our Finance Team Leader, to talk about some big changes in the lending market and the wider property market over the last month or so. Welcome, Calum.
Thanks, Emma.
Now, it's been a big month for the lending industry, with APRA announcing a revision of their serviceability guidelines for lenders, particularly relating to residential mortgages. So, Calum, let's have a little chat about what those guidelines are now.
So APRA require the lenders at the moment to use the higher of either a serviceability rate of 7%, which is also known as a floor rate,
Sure.
or a buffer of 2% above the actual interest rate.
Mm-hmm.
Now, one of the other guidelines also require the lenders to actually use an assessment rate or within their assessment to make sure they're comfortably above these rates. So that's defaulted in a lot of lenders actually adopting a floor rate of 7.25%. So with the way interest rates are at the moment, they're at historical lows, and essentially, experts are actually forecasting the next rate movement will be a rate cut. So I guess the gap between the actual interest rates and the serviceability floor rates have become unnecessarily high.
So that sounds like something that would have a big impact on loan applications. What are APRA's proposed changes?
Sure. Well, I guess the first one being is they're looking at removing the floor rate altogether. So the 7% floor rate, they're looking to remove that. The second one is the serviceability buffer, increasing that from 2% to 2.5%, but also remove the expectation of the guidance around the lenders requiring to remain comfortably above these buffers. So what that's going to enable is the lenders to actually create their own floor rate and make it more in line with the current conditions and I guess the interest rates that borrowers actually are experiencing at the moment.
And so from your on-the-ground experience, seeing how these serviceability metrics have been impacting buyers and borrowers over the last couple of years, what kind of impact could these proposed changes have on the market and the lending market?
Yeah, I think obviously it's been very difficult for borrowers in the last few years, particularly around serviceability. A lot of people are probably finding when they either go to refinance or purchase another property, they're finding that they can't borrow as much as what they used to be able to. So we expect that if the lenders do adopt these changes and pass it on to the borrowers, it will significantly increase their borrowing capacity, and it's going to come down to individual circumstances as well. So individual borrowers will be affected in different ways, but overall we are expecting an increase to capacity.
So could you give us a couple of examples of how that might play out?
Yeah, sure. So we looked at a few scenarios. The first one, we had a couple with one dependent. They were on a household income of roughly $135,000, and that included rental income from one investment property. Now, they were looking to refinance their home loan of $400,000 and roll over the interest-only period for another 5 years. Now, under the current guidance and the current assessment rates, they could only borrow up to $354,000, and with the proposed changes, that they were able to then refinance the loan. So it represented roughly an increase of 13% in that scenario.
Jay?
Yeah.
Well, what about for a home buyer who's entering the market? How would this change in serviceability impact their ability to make the decision to buy?
Yeah, well, home buyers are they're going to have quite a significant increase as well. I guess part of the reason the changes have been brought on is the fact that the rates are different between certain types of borrowers now. So it's no longer one reference rate for all types of borrowers. You have a difference between investment interest only to investment principal and interest, again to owner-occupied interest only, and then again to owner-occupied principal and interest. So these are all different rates on offer that the banks are offering, and APRA have recognised that, which is good. And so, for example, for a homeowner or a first home buyer, we know the principal and interest owner-occupier rates are quite low at the moment, as low as 3.5%. If they just adopt the serviceability buffer of 2.5%, it's going to result in a reduction of about 1.25% in the assessment rate, and that'll significantly increase the borrowing capacity for that person.
So that for some buyers could mean the decision to purchase or not And for others, I suppose, gives them a much wider choice between the different suburbs or property types that they could access as a result of those serviceability metrics.
Yeah, definitely. I guess, for those who weren't able to refinance or extend their interest only periods, it could be, it might mean the option that they all of a sudden can now do that with the proposed changes. And again, for those people looking to upgrade or purchase an investment property, it might mean they can now afford to go into a better suburb with a better quality property.
It's interesting, this comes on the back of the election result with Liberals forming government, and so Labor's proposed changes to negative gearing and capital gains tax being abandoned. And so the combination of these factors, we feel, is bringing some good confidence and certainty back into the property market. Of course, this will affect different cities in different ways. For a city like Perth or perhaps Brisbane, where there's other good fundamentals like affordability and wage growth and strong economy, this is just one more factor adding some certainty and some confidence into the market, which is great news for investors and homeowners as well. So Callum, if I'm a borrower and I have an application pending, my broker's told me that I can achieve my goals based on the current guidelines, should I hold off until the changes come into effect?
It's a good question, Emma. If you qualify now, you should continue to move forward with your plans. The fact that the borrowing capacity is increasing, you already qualify, so that's not really an issue for you in the current environment. Mm-hmm. So I guess the risk of actually waiting, if your situation does change with you waiting for these changes to come in, you might find that you no longer qualify, and each bank is different as well. So the bank you're considering might delay the changes, and that just keeps you in limbo for longer. So there's no point sitting around just waiting for something that you can actually go ahead with now.
Absolutely, and of course, these changes from an APRA point of view are welcome. However, banks are known for having quite complicated serviceability calculators, and so they do change some of those factors from time to time. So even if a borrower doesn't think they've had a big change to their own ability to pay, the bank might see it quite differently. Yeah. Any final advice for buyers or investors, Callum?
I guess great news for the industry, as we've mentioned, and it's very positive moving forward. So I would recommend speak to your broker, especially if you've been looking at refinancing your existing loans or potentially looking at getting into the market and you've found the borrowing capacity hasn't quite been where you need it to be. Speak to your broker. They'll be able to model out based on proposed changes if you will be able to qualify, and the sooner you do that, the better position you'll be in.
Thanks, Callum.
Thank you.
Thanks for joining us today. We're certainly pleased to see these events unfold and the certainty and the confidence they're bringing back into the lending and the wider property market. But of course, your own circumstances and your own goals are a really important part of what you decide to do next. So if you've got any questions about how these changes impact you or the next step on your property journey, give us a call. We'd love to hear from you.